In 2013, Chinese President Xi Jinping unveiled the Belt and Road Initiative, a plan to connect Asia, Europe, and Africa through new infrastructure. The vision was sweeping: ports, railways, highways, and power plants, all built with Chinese financing and expertise. China framed the BRI as a path to shared prosperity, especially for developing nations hungry for growth. The reference to the ancient Silk Road conjured images of peaceful trade and cultural exchange. The Belt referred to overland corridors, the Road to maritime routes linking continents. Together, they would form a vast web of trade and investment, with China at the center. But the BRI was more than economics. It was a cornerstone of Xi's foreign policy, designed to project Chinese influence. By funding and building critical infrastructure, China could secure access to resources and new markets. For a time, the BRI seemed unstoppable, a force destined to reshape the world. But beneath the surface, questions lingered. Who would really benefit, and at what cost? The stage was set for a new chapter in global history. The Belt and Road Initiative is the largest infrastructure project in history, spanning over 150 countries and organizations. China pledged trillions of dollars, funding not just roads and railways, but energy pipelines, telecom networks, and special economic zones. Flagship projects like the China-Pakistan Economic Corridor and the high-speed rail from Kunming to Singapore showcase its ambition. In Africa, Chinese-built railways connect Kenya and Ethiopia. In Europe, China has invested in ports like Piraeus, Greece. Financing comes mainly from Chinese state-owned banks with hundreds of billions in loans. The Asian Infrastructure Investment Bank was created to support these efforts. This financial muscle let China fund projects that Western lenders often avoided. The BRI also includes a digital Silk Road, laying fiber optic cables, building data centers, and rolling out 5G, often with Chinese tech. During the COVID-19 pandemic, the Health Silk Road emerged, distributing vaccines and medical supplies. The BRI's adaptability lets China advance its interests across construction, finance, technology, and health. Its reach is global, its ambition unmatched. But as the BRI expanded, so did scrutiny of its methods and motives. The world began to ask, what price comes with this new connectivity? The BRI's promise was mutual benefit. China's capital and expertise, developing nations' need for infrastructure. Many hoped new roads and ports would boost trade and lift millions from poverty. But as projects broke ground, problems surfaced. Chinese loans often carried higher interest and shorter repayment periods than those from global institutions. Contracts typically required Chinese companies and labor, limiting local benefits. Promised jobs and economic growth often failed to materialize. Debt-trap diplomacy became a concern. Countries unable to repay loans risked losing control of strategic assets. China could demand long-term leases, resource rights, or political support in return. Critics argued this was China's plan all along, to gain leverage by creating webs of indebted nations. Initial enthusiasm faded. Governments grew wary, some canceling or renegotiating deals. The BRI's narrative shifted from shared prosperity to caution and suspicion. Countries began seeking alternatives, wary of the high price of Chinese loans. The BRI was no longer just about infrastructure, it was about sovereignty and the true cost of partnership. The world realized that not all that glitters is gold. The BRI's reality was far more complex than its original promise. The dream of a win-win solution was giving way to a new, more complicated reality. Hambantota port in Sri Lanka became the BRI's most infamous cautionary tale. After being rejected by other lenders, Sri Lanka turned to China for over $1 billion to build a new port. The project struggled from the start. Far from shipping lanes, it failed to attract business and generated little revenue. Debt payments became unbearable, plunging Sri Lanka into crisis. In 2017, desperate for relief, Sri Lanka handed the port to a Chinese company on a 99-year lease. This move sparked outrage and fears of lost sovereignty. Critics saw it as China using debt to seize a strategic asset near key shipping lanes. Hambantota became a global symbol of debt-trap diplomacy. The lesson was stark. Chinese loans could cost a nation control over its own infrastructure. China insisted it was a commercial deal, but few were convinced. The port's fate sent a warning to countries considering BRI projects. The price of partnership with China could be far higher than expected. Hambantota's story continues to shape the debate over the BRI's true intentions. The China-Pakistan Economic Corridor, or CPEC, is the BRI's flagship project. $62 billion in roads, railways, and pipelines linking Gwadar port to China's Xinjiang. For China, it's a strategic shortcut to the Indian Ocean, bypassing maritime choke points. For Pakistan, it promised jobs and an end to energy shortages. But CPEC has faced major hurdles: security threats in Balochistan, ballooning debt, and limited local job creation. Many contracts went to Chinese firms, who brought their own workers and materials. Local businesses struggled to compete, and promised prosperity has been slow to arrive. Pakistan's debt to China has soared, raising fears of a Sri Lanka-style debt trap. Geopolitically, CPEC has heightened tensions. India opposes the corridor, seeing it as a violation of its sovereignty. The project has deepened the China-Pakistan alliance, challenging the regional balance of power. CPEC is still moving forward, but it's no smooth success story. Instead, it's a complex, controversial corridor, full of promise, but fraught with problems. The world watches closely, wondering if CPEC will deliver transformation or turmoil. The answer remains uncertain. Not every BRI project is a cautionary tale. Some have delivered real benefits. The port of Piraeus in Greece is a standout example. Acquired by China's COSCO in 2016, the once struggling port is now one of the Mediterranean's busiest. Chinese investment brought upgrades, jobs, and economic revival to the region. Piraeus became a major gateway for Chinese goods into Europe, a win for both Greece and China. In Central Asia, new railways like the Khorgos Gateway have transformed trade. Goods now move from China to Europe in weeks instead of months, opening new opportunities for landlocked nations. These projects have helped integrate Central Asia into the global economy and reduced reliance on Russian routes. While concerns about debt and influence remain, the economic benefits of improved connectivity are clear. These successes are often overshadowed by controversy, but they show the BRI's potential when projects are viable and well managed. The initiative's legacy is mixed. Failures dominate headlines, but bright spots exist. The BRI's story is not all doom and gloom. In some places, the promise of shared development has been at least partially fulfilled. The BRI's infrastructure boom has come at a steep environmental cost. Many projects, dams, coal plants, highways, have left a heavy footprint, locking countries into fossil fuel dependency. Construction often cuts through sensitive ecosystems, causing deforestation and habitat loss. Environmental reviews are weak, and local communities are rarely consulted. China has promoted a green Silk Road, encouraging renewable energy and better practices. But most BRI energy projects still rely on fossil fuels. The environmental toll may be the BRI's most lasting legacy. Prosperity built on environmental destruction is a dangerous paradox. The shadow of ecological damage hangs over the entire initiative. Optimism about the BRI has faded, replaced by skepticism and backlash. Debt-trap diplomacy and controversial projects have fueled public protests and political opposition in many countries. Western rivals have launched alternative initiatives, promising more transparency and higher standards. The BRI has become a flashpoint in global competition, with developing nations caught in the middle. China has responded by shifting to smaller, more sustainable projects and renegotiating debts. The era of massive, risky investments is ending. The BRI is entering a new, more cautious phase. Its future will be shaped by global resistance and the need for reform. The world is demanding a better model, and China is being forced to adapt. As of late 2025, the BRI stands at a crossroads. The grand vision has collided with debt, controversy, and fierce competition. China is shifting to smaller, smarter, and more sustainable projects. The BRI's legacy is mixed new infrastructure and influence, but also debt and resentment. Western alternatives are forcing China to compete on quality and transparency. The BRI's future will depend on its ability to adapt to a more skeptical world. The story is one of ambition, consequence, and unfinished business. The still unknown. The journey continues, and the stakes remain high.